Welcome to the Startup Competitors Podcast, where we talk with early-stage entrepreneurs to understand what information they use to inform product roadmap, strategy, and market differentiation.
Hey there, welcome to the podcast. Today we have a good one. We're talking with Tom Wallace, who's the managing partner of Florida Funders. Florida Funders is a venture capital group out in Florida. They invest in deals in Florida as well as the Southeast region. Over 40 companies in the portfolio, another 40 that they manage on behalf of the state of Florida. Great experiences shared around vetting early stage companies, investing in early stage companies. Tom shares a lot of his background as a founder himself, growing some companies. Spent a lot of time talking about those things. We also talk about angel investing for the first time, things to think about. Super fun conversation, packed with a lot of information. Hope you enjoy it. Find Tom online. Thank him for being on the show, and thank you so much for listening. With that, also want to do a quick shout out to Fuel Merchandise Group. Fuel is one of our newer sponsors here to the podcast. You can find them at fuelmerchandise.com. If you need any brand marketing or products for your company, you can get 10% off your first order. Just mention Startup Competitors at fuelmerchandise.com. And with that, we'll just get right on to the show. Thanks so much for listening. Welcome to the podcast. Today we're chatting with Tom Wallace, who's the managing partner of Florida Funders. Tom, welcome.
Thanks, Mike. Happy to be on the show. Thank you for having me.
Why don't we start with a quick pitch or overview of Florida Funders? What do you and the team do?
So we find, fund, and build the next generation of great technology companies here in the state of Florida. We do invest in the Southeast as well, but we're primarily focused on Florida. And we're a combination between a venture capital fund and a crowd network of angel investors of about 1,500 angel investors. And we invest in early stage tech companies. And we're scouring the state all the time looking for the next unicorn.
Hit me with some quick vanity metrics. So you said the 15,000 angel investors. How many startups have you guys funded to date? How much capital? Anything you can share that would provide some of that?
I'm happy to do it. We've been at this about 4 years, Mike. Our first fund was an $18 million fund, which we've just about fully deployed. We're about to start on our second fund, or we started on our second fund. We've invested roughly $40 million over these 4 years. That will accelerate in the years to come. We have over 40 companies in our portfolio of companies we've invested in. I think we're closer to 50 now. And then we manage another 40 companies, portfolio of 40 companies for the state of Florida, because they used to be in the venture capital business, got out. And so we manage those 40 companies for them as well. And we have 1,500 investors, and our investors are accredited investors. So these are people all with a net worth of over $1 million. And you probably know a little bit about the accredited investor status. And we have 12 full-time people on our team. And we're based in Tampa, Florida, but we have a presence in Miami, South Florida, as well as Orlando and across the state. But we have most of our team located here in Tampa.
Awesome. Perfect. And sorry about the typo on my part with the 15,000 versus 1,500. I was going to ask you how the heck you found 15,000 investors.
Yeah.
But 1,500 is still very impressive.
Well, if you think about the state of Florida, we have the third largest number of accredited investors, only behind California and New York. And we have, you can Google it, roughly 400,000 accredited investors. So we've got a big pool to work on. But unlike California and to a certain extent New York, most of our investors in Florida, our accredited investors, didn't make their wealth in technology. So they're not as prone to being angel investors. So we do a lot of what we do is educating people on why to become an angel investor, how to do it right, what this asset class is all about, how much of your asset allocation should go into angel investing. And our part of our goal here is to wake up this sleeping giant of all these accredited investors so that we have a lot more early stage capital being invested in technology here in Florida.
Well, thank you for your service. We need that, I think, in a lot of different states, not just Florida.
Absolutely.
All right. Well, I guess a couple of different ways we could take this. Let's start with the startups, and then I want to circle back to the investors and kind of how do you educate them. But maybe walk me through, if I'm a startup and I would like to, work with Florida funders from an investment perspective. Talk me through that process. What does that look like?
Yeah, just go out to our website, floridafunders.com, and we have a very simple application process. Take you about 10, 15 minutes, and that'll really get the process started. It is a process. It takes a while. There are different, stages of it, and, people get dropped off as we go along. We're just trying to find a good fit. We're trying to find a company that is what we're looking for, and we tend to invest in what me and my partners know. We have backgrounds in software, SaaS software, cybersecurity, ed tech, digital health, fintech. That's kind of our focus. So we'll have people go on and apply in like bio life sciences. That's not really what we do. So some people get cut out of the process pretty quickly, or they read what we're looking for and realize they're not a good fit. And then others make it through our whole process, which takes from beginning to end, roughly 30 to 60 days. And then if they get all the way through, then they make it to our final investment committee, which the founders then pitch us, our investment committee of about 8 people, and they pitch us, and then we make the final decision: are we going to fund them or not? Our average check size is right about $1 million. So that's what we put in each company, roughly half of that coming from our fund and half of it coming from our angel network of investors.
And that match from the angel network, is that pre-committed dollars, or is that they're looking deal by deal and making the choice if they want to fund?
It's a little bit of both. I know that sounds a little nebulous, but we have a program called Portfolio Select where an investor can put up a certain amount of money. So they say they put up $100,000, and then they would choose to invest $10,000 in our next 10 deals, as an example, or $5,000 in our next 20 deals. Or they can just, look at each deal individually, invest it as they like. My partners and I invest alongside of our angel network. So we're investors both in our fund, and I personally do nearly every company, and as do my partners. So one of the things that we educate our angel investors on is very important in angel investing, as in most investing, to diversify. Mike, if you said, hey, I want to become an angel investor, I've never done this before, the first thing we're going to do is say, look, you don't want to come in and do 1 or 2 deals. You want to do a 10. You need to build a portfolio of 10 investments, because this is a high risk, high reward business. So let's just say you invest in 10 companies. Our rule of thumb is probably a third to a half of those are going to go bust. We use a third are going to go to zero. A third, you're going to get your money back, or some percentage of your money back, or a very small return. And you're going to make all your returns on the top third. And typically you're going to make all your returns using the example of 10 on 1 or 2 investments. Those that hit will hit big. They could be a 20x, a 30x, a 40x return. So that's the game we play. And if you only come in and do 2 or 3 deals, the odds are against you. We tell people, if you're going to do that, you might as well just go to the casino. You might get lucky, but the chances are against it. But this asset class of angel investing in early stage tech, if you compare it to all the other asset classes, whether it be public stocks, bonds, real estate, venture capital, private equity, it outperforms every other asset class if you do it right. And that's you can Google that too. That's fairly well documented. And the Angel Capital Association of America has a lot of stats on that if you want to go visit their website.
Oh man, I want to switch to founders. Okay, I mean investors. Let's keep going down that thread since we're there. So when you've got a first-time angel investor, walk me through that process of getting them comfortable, not just with the portfolio math and kind of how that works, but even like, how long is this money going to be tied up? What are the tax implications? Like what's the process that you guys walk them through to get them comfortable with the choice to invest?
Yeah, that's a good question. So this is not a liquid investment. If you choose to invest in one of our companies, we tell people a 3 to 7 year time horizon for a harvest or an exit is typical. They can go a little longer and they can go quicker, but that's typically what we tell people to plan on. And there's no liquidity, between that. Typically, there's no way if you decide halfway through it, you don't like what they're doing, or you want your money out, or you need the money for some reason. That's really not a viable option today. That may change in the future because there's some people working on that problem. But that's part of the education process. This is a long-term play, and very few companies become overnight unicorns. It doesn't work that way. I mean, Microsoft was in business, 10 years before they went public, and Uber and, Airbnb just went public this week, and Postmates. I mean, most of those companies are 6, 7, 8, 9, 10 years old. So again, sometimes it goes quicker. We just had 2 exits in the last 2 months. One was a 4-year-old company, and the other one was 4 or 5. So it was a little quicker. But yeah, so we really want our investors to understand that this is a long-term game, and getting out early is not A, an option, or B, oftentimes wise. And sometimes you want to double down. It's very common for our investors to have an opportunity to invest further in a company after their first investment in a later round, we call it. If they like the progress the company's making and what they've done, they should do that. And oftentimes we Florida funders do that.
Talk to me a little bit about how you and the team think about investment structure. Does it matter if it's equity, safe, convertible note? Does it matter if it's an LLC, C Corp? Does it matter, some of the rough math you hear kicked around the amount of the raise versus the valuation? Just anything you have for how you guys think of these things?
Yeah. So we do both equity and convertible notes, which a safe is basically the same thing. We do look at valuation very closely. It's a very important part of what we do. And we think it's one of the advantages of investing in Florida companies and Southeast companies. We don't have the same valuations that New York City has, and certainly Silicon Valley and San Francisco have. So we're typically investing in companies when they're valued around somewhere between $3 and $10 million. So we don't need a company to, again, be a unicorn or have an over $1 billion exit for us, our investors, to get a great return.
Right.
If we invested a $5 million valuation and they never have to raise any more money and they exit at $100 million, it's a 20x return for our investors. So we do look at valuation, and it's always a negotiation with the founders. And one of the advantages of doing a convertible note, as you're probably aware, is it pushes the valuation question down the road, so that we're going to convert into the next round at like a 30% discount, which is typical to the next round. And we leave the next round, which is usually an institutional round led by an institutional VC, let them set the valuation, and then we get rewarded for investing early at a discount. And we, Florida funders, we do not do convertible notes or safes without a cap. So there's always a cap to that next round, so that if that company, let's just say, they skyrocket, they never have to raise another dime of money, and, they have an exit at $300 million 2-3 years down the road, we've negotiated a cap. So, let's say we might have a $25 million cap. So we get rewarded for investing early should that happen. So we're very cognizant of that, and we never do notes without caps. And then as far as the LLC or sub S, our investors are always investing in an LLC with us. So we form what we call an SPV, a special purpose vehicle, which is an LLC. So from the founder standpoint, the company's portfolio company standpoint, we're only one entry on the cap table, and all our investors are part of the LLC. And we handle all the taxes, and we handle all the reporting, and we have it all up on our portal, and they can go up and get updates on the company and their latest financials and what the company's doing. We make that very easy for our investors. We like to say we take all the heavy lifting out of angel investing, because if you're doing it on your own, and I did it on my own for 25 years, it's a lot of work. Negotiating the terms of the deal, all the legal docs, hiring the lawyers, doing the due diligence, calling customers, interviewing them, checking the backgrounds of the founders. All that stuff we do, and we put up on our portal for our investors. So we make it very easy for them to evaluate the company, the founders, the technology, so they can decide whether they want to invest or not.
When you reflect on maybe some of the better pitches that you've heard across those 40 companies that you've invested in, what are some of the highlights? What are some of the good behaviors that you see again and again and again that you think to yourself, man, I wish every pitch went this way, or I could replay this for some other founders?
Yeah, good question. And trust me, we coach our founders before they present to our investors. The first thing, keep it simple. You got 2 minutes to give these people your elevator pitch. They have to get it. If you can't explain what you're doing to potential investors in the first minute to 2 of your pitch, it's not going to go well. So you got to keep it simple. You got to keep it clear and concise. Other things we see with founders that we really like are, your deck should be simple. You don't need a zillion slides. Don't try to communicate everything. just try to communicate what's most important, be engaging. And this is a big one. So typically a founder has about 20 to 30 minutes to present. Then you go into Q&A. And when you go into Q&A, a lot of times they do well in the pitch, and then you get the Q&A, and that's when they really bomb. And one of the things we try to teach them on the Q&A is answer the question you were asked, only the question you were asked, and answer it, and make your answer short and brief. I guess that's redundant, but short and simple, sweet and simple, whatever. Because so many founders, when it comes to the questions, they really never answer the question. They go on and on and on, and that really can be the kiss of death for many investors. And then the other thing that we really like to see in the pitch from the founder is focus. Don't get in front of investors and tell them, yeah, we're going to do this, and we got this great product or, SaaS software, whatever. Oh, and then by the way, we're going to accumulate all this data, and then we're going to be a data company. And data we're going to be more of a data company at the end of the day than anything. Not what investors are looking for. They want to see, do one thing, do it really, really well, and stay focused. And many founders make that mistake. If I've heard the data thing once, I've heard it 100 times. I've yet to see any company that started off as a software company or, a security company or whatever that became a data company. And if you're going to be a data company, start off as a data company and be a data company. Otherwise, stick to what your core business is.
I like it. That might be the hot take.
The other thing that founders, founders, they tend to put up projections that look like a hockey stick, right? So their revenues are pretty minimal now. And then over the next month, 12 months, 18 months, 24 months, they go through the roof, right? And then this is the other one that we hear all the time and then they say, and these numbers are very conservative. Yeah.
Well, I was going to try to play devil's advocate to that, but then you said, and then these numbers are very conservative.
Yeah.
So how does a founder, maybe I'll just poke at that a little bit. So if I'm a founder, which I am, sometimes I feel like, well, yes, I don't want to put the hockey stick in front of you because I know it's BS too, right? Like it's probably not going to happen. But the flip side of that is I sometimes feel like if I show you my real projections, what I think we're really going to do, which is going to be, we're going to be a 10-year overnight success, which means the first 5 years are not going to be that spectacular. You won't want to invest, right? Like, I also want to show that this can be a big enough opportunity, and that's sometimes hard to do in a 3 to 5 year projection. So how does a founder think through balancing that? Like, I want you to think this is attractive and exciting, but I also obviously don't want to mislead you.
Yeah, I don't know that the exact numbers, especially really early stage. Now, we tend not to do pre-revenue deals. So most of the companies we're investing in, they have some traction, some customers, some revenue. Frankly, if I see that they're going to double every 6 months, that's not a hockey stick, but that's really nice growth, and that's realistic. It's not just the numbers, and you can show the hockey stick. It's more about how you're getting there. Can you articulate and sell us, the investors, on why your growth is going to accelerate, when it's going to accelerate, and why? And is the money we're giving you, how are you putting that to use to drive that acceleration of that growth? So it's a lot about how you position it, how you sell it for the investors. We want high growth. We're not, this is a high growth type of investing. We're not looking for somebody. I had one of our portfolios come to me last week or 2 weeks ago, whatever it was, and they were presenting their plan for next year. And they did 1.2 million in recurring revenue this year, and their goal is to go to 2 million next year. And my feedback, they presented it, and they said, "Well, what do you think, Tom?" And I said, "Well, you're 1.2, you're going to 2 million. That's not really very exciting for an investor. If you're 1.2 this year, my question is, how do you get to 4 or 5 next year? That's what you should be figuring out. And if you're showing me a plan of 2 million, where's that get us? That's not why we invest in early stage. This is growth investing. This is, growth equity. This is not, going from 1.2 to 2 million. Now, if you're a mature company and you're, doing 100 million and you're going to 110 or 15 million, that's okay. But that's not where we're at with these companies. And we're looking for, we want to see them double every 6 months. We're looking for that kind of growth.
So if you look at that portfolio of 40-ish companies that you've invested in, is that skewed one way or the other in terms of B2B versus B2C?
Yes, we primarily invest in B2B. We being me and my partners, our personal backgrounds, almost all of us except one are former entrepreneurs. I've been an entrepreneur my whole life. I started my first business when I was 23, and for your listeners, I'm 62. So I've basically built and sold businesses my entire life, as many of my partners have. One of our partners is a pure venture capital guy that's always pretty much been in the VC business. Well, actually, he was an entrepreneur for a short period of time. But anyway, our backgrounds are primarily B2B. Now, myself and one of my partners do have somewhat of a B2C background. My last exit was an online training and education company that we sold out to private equity after 13 years. And probably 20% of our business was B2C. So I do have a little bit of a background in B2C, but I would tell you as a whole, we're focused on B2B. We love the B2B space. It's what we know. We try to invest in what we know. And the other thing I would tell you, part of our formula here at Florida Funders, we don't just write checks and say, hey, go off, have a good time, let's know how it goes. We really look to get involved. We typically take a board seat. That board member for us is going to be a coach and advisor, mentor to the CEO. We look at how we can help that company be successful. The board member will typically be what we call an operating partner. So they'll be responsible for making introductions. Any way we can help that company, for example, into companies for early stage customers. If they need help recruiting, we'll look at, okay, you need a CTO, you need a chief revenue officer. How can we help with that? So we really look to increase the probability of our companies being successful by leveraging the experience and background of our large investor base and really plug in an investor that knows their space and that we really think can help that company be successful.
This episode is brought to you by Full Stack PEO. Most founders start companies because they figured out a better way to solve a problem or serve a need, not because they love tracking payroll, filling out compliance forms, and explaining employee benefits packages. And yet, all that stuff still has to be done. That's why there's Full Stack PEO. Full Stack PEO specializes in turnkey HR for emerging companies, not just those core services, but advice and expertise that help founders maximize employee potential. Curious? Find out more at fullstackpeo.com.
So then, and I promise there's a theme to all this. So then when you look at the B2B space, is there a preference for a sales-driven B2B organization versus more of a marketing-driven organization, right? So one where I can just show up on the website, swipe the credit card and go, versus one where, it's more smiling and dialing, appointment setting, doing demos, getting pricing, stuff like that.
I kind of look at that a little bit differently, where I follow what you're saying. On the B2C side, it's more marketing and it can be more transactional and you can drive it through digital marketing. B2B, these are typically one of the biggest challenges and problems our founders have is building and scaling a sales team. And
good. This is where I wanted this conversation to go.
Yeah,
go
a lot of times they just have never done that. And they get those first 6, 12, half dozen customers, and then they kind of don't know where to go from there. They've never hired salespeople. They've never trained them. They never understand their comp plans. We have extensive experience and backgrounds and our partners and our investors in doing that. And it's one of the ways we add value. I grew up in the world of the personal microcomputer industry and later networking. So I worked with companies like Microsoft and Cisco, and I was on Microsoft's advisory board back in the day. One of the things I learned in technology, the best technology almost never wins. Microsoft never had the best technology. Every early product that company ever released, and I was a VAR of theirs, they were terrible. I mean, the early versions of Word, Excel, their networking products, but they were really good at sales and marketing. And and by the way, Cisco was the same way. I had a company, we resold Cisco's VoIP product, voice over IP, back in the late 90s. The product didn't work. They shipped it for a year. It was so buggy, it literally didn't work. But when it came to sales and marketing, you did not sell or market Microsoft. You did not sell or market Cisco. I mean, that's where they really, and we try to coach our founders on that. Look, you just can't build a great product and say, oh, the world's going to beat a path to my door. Doesn't work that way. You're going to have to sell it. You're going to have to market it, and your ability to do that is going to be paramount to your success.
Is there a way? So I'm actually, I guess I'll get really specific. So you're typically looking at deals that are post revenue. So there's some, sales that they've obviously done. Do you have a way to filter out how much of this is, because I feel like, I guess maybe I'll start with the premise for this conversation. We've been head faked a couple of times where, and I personally have done this where, we built a product. I was very successful with the first few sales. And then, as we started to try to scale a sales team, we just did not see the same success. And then I started to try to sell it more and did not see the same success. So it clearly also wasn't me. And in the head fake there that I've seen in a couple of different companies is that, you get a couple of founder friendly early sales. It looks like, from the outside, it looks like traction, looks like product market fit. But what it really was, a well-primed network, personal relationship, whatever that is. And it turns out to not be scalable at all. And that can be really hard to see until you get that first round of funding and get a team in there. Do you and the team look for that? How do you look for that? What are some ways to sniff that out?
Yeah, we definitely look for that. And one, in our due diligence process, which is very extensive and very lengthy, and frankly, we lose some deals over it because some of the founders get frustrated and like, nobody else is digging in like this. Nobody else is asking these questions. And, it's just part of our process. It's part of what we think is our secret sauce for our investors. So we don't bend on it. But the two things we look most at are the founders. We look at them. We look at their backgrounds. We look at, we're looking for certain things in founders. We're looking for perseverance. We're looking for somebody who's not going to quit. This is going to, Mike, building businesses is really, really hard. The punches in the face are coming. If you're not tough, if you're not persistent, if you're not somebody that can get knocked down and pick yourself back up, and then, so we're looking for that with our founders. We're looking for integrity. We're giving these people $1 million checks, sometimes more. Can we trust them? Do we know that they're going to invest and spend this money like it's their own? These are some of the things we're looking for in those founders. We'd like to see a team of two rather than an individual, although we do both. And we want to see somebody's got to be able to sell this. Can somebody articulate the vision, therefore be able to sell it for recruiting purposes, to build a team, because it's all about your team, right? You got to build a great team. And can they sell customers on this? And then ideally, it's the Jobs and Wozniak thing. You got the great sales marketing guy and the great tech guy. If they're missing one of those, we're a little suspect there. But the second thing we do in our due diligence process and spend the most time on is interviewing the early customers. And we're looking for exactly what you're saying. We're really drilling. And I learned this from years of running a private equity-backed company where we acquired a lot of companies. Those were extensive interviews with those customers. And by the way, we want to pick the customers we talk to, not the founders who they tell us to talk to. And we do extensive interviews. Why did you buy this product? What other products did you look at? If we yank this product out of here tomorrow, how does your life change? And we want to hear they love it. We want to hear they're telling friends about it. We want to hear that it's not something that's nice to have. They couldn't live without it now, and they don't know what they did with before it was there. So we're looking for that in that product market fit, as you said. And we want to know, how'd you find out about the company? How did you find the product? And we don't want to hear, the CEO's one of the investors, and he told me to take a look at this. That's not what we're really looking for. We want to hear, we had this problem. It was a big problem when we've been searching for a long time for a solution. And, these guys came across, or these gals came across our radar, and, stuff like that. So, yeah, we're really looking at those early customers, and we want to make sure that they're not just early adopters that buy everything and try it, and if it works, because, that doesn't scale, as you pointed out.
How often does so you said you sometimes play ideally in a perfect world, you'd love to be more active after you're writing the check, right? It's not just money, but you guys might be able to lean into some of your prior experiences and help a founding team out. How often does the team take you up on that? And I'm sure it's, quite often when you initially write that check, but once the honeymoon period is over, right? It's a year later, it's 2 years later. How often are they reaching back out to you and saying, hey, we've hit this problem. Have you guys seen this before? How can you help?
Yeah, I would tell you that we have two types of investments here. We have passive and active, and the active ones were usually the lead investor. So, and like 75% of our investments were the lead investor and we're active.
Wow.
25% of them, we're just writing a check. We're not the lead investor. We're investing alongside other people we probably trust and believe in. We don't have a board seat, and we're writing a check, and we're going to help the company any way we can if they need introductions into Publix supermarket. We have contacts at Publix and umpteen other companies. I'm just throwing Publix out, and we'll help them that way. But it's going to be really minor. Where when we lead a deal and we're the lead investor, we're going to take a board seat. We're going to be in contact with that company for years and years, really, till we exit. And we're going to get very involved. And the first thing we do as soon as we make the investment, we do a deep dive where we bring the founders into a room with a bunch of us, and we spend one whole day going through every aspect of their business. What's their marketing plan? What's their sales plan? What's their product roadmap? What are their financial and reporting structure look like? What's the team look like? Where are the gaps? And we really kick off the relationship with that deep dive. And from then on, we're really trying to help that founder be successful any way we can. And we have a woman on our team, Candace, who's our director of founder success, and that's her sole job, is to work with these founders. And by the way, introduce them to each other. So many of our founders of our portfolio companies know each other, and if there's ways they can work with each other, help each other out. We try to promote and facilitate that as well.
Awesome. All right, getting close to time. Before we wrap up, other kind of tips, do's, don'ts for founders as they kind of either think of their initial pitch or go through the diligence process? Other things you want to point out that are kind of common gotchas that teams get hung up on?
Yeah, a couple of things I would tell you we want to see from founders. We want to see them have skin in the game. We want to see either they've written a check or they've worked for months, if not years, at well below market. If somebody comes in and is like they're paying them, they give them the budget, they're going to pay themselves $200,000 a year, and they don't have any of their own money in this. We're not that interested. So that's one of the things that we see. Again, focus. A lot of times they have trouble really articulating the message and exactly what they do. They've got to get to that really quick. And then the other thing too is we want to see people that are passionate about what they're doing. We're not into the balanced lifestyle that many millennials want to live today. Frankly, we don't care. We ask the question, what do you do on the weekends? We don't want to hear golf, sail, hike. We want to hear work. I like to work on weekends. I spend most of my weekends working, and I haven't taken a vacation in 2 years. We want people. Did you ever hear like Elon Musk, like how often Musk took vacation when he was building PayPal and his companies? Like I never went on vacation. I worked like a dog. I mean, building companies, like we've already discussed, is not only hard work, it's a lot of work, and the odds are against you, and you have lots of competition, my brother, who's a little older than me, and he sold his company to a publicly traded company down the street here called Roper Technologies, one of the largest software companies in America. He sold for $1.6 billion about 2 years ago. And I watched my brother build this company over 13, 14 years, whatever it was. And he always said, Tom, I'm not the smartest guy in the room. And, frankly, I came from outside this industry, but no one will outwork me. And he was the first guy in the office and the last guy to leave. And he, probably flew 1 million miles a year, offices in London and Japan and all over the place. And, that's what we want to see. We want to see that kind of dedication from a founder. And, that's what it takes. It's just, it takes passion. It takes hard work. It takes tenacity. It takes perseverance. And I think there are a lot of young people today that just, they want to be the next Elon Musk or they want to be the next Mark Zuckerberg because it's very glamorous and, they see these people, but they just don't have a clue as to how hard these people work. And, and you need to get lucky too, or have some amount of luck.
All right. You've given me a new thread to pull on, so I'm going to invoke executive privilege and force you to stay with me for another 5 to 10 minutes.
No worries.
So both you and your brother were entrepreneurs. You both have exits, clearly strong work ethic. Any other siblings in there, or just the two of you?
We have two sisters. We have we're Irish twins. He's 13 months older than me, or almost Irish twins. And then
right on.
We have an older sister, 3 years older, and a younger sister, 3 years younger than me.
Are they entrepreneurs too?
No, my older sister worked for me for most of her career. So she's been with me with a bunch of my companies over the years. And my younger sister has been mostly a stay-at-home mom for.
So I have 2 young boys, and I'm constantly, dwelling on how I'm screwing them up as a dad. I'm super interested. What do you think, led to you and your brother going down that path? Because I would say to have 2 of those in one family seems rare. What? Think back to your childhood and what happened there.
Well, neither of my parents graduated from high school, and my father was a union guy, and he climbed utility poles. He was a lineman, if you know what that is.
I do.
And, we saw him work for the same company for 42 years. And, and I think at a very early age, I was an entrepreneur probably 20 years before my brother. My brother worked for Arthur Andersen for over a decade, and he became an entrepreneur about midway through his career. But for me, it was very apparent that I didn't want to spend 42 years of my life working at the same company to retire and get a letter opener. And that, that I guess I was also always more adventuresome and more of a risk taker. And so our parents were not that way at all. I remember when I was 23 and I left a job at my only real job. My father said I worked at Alcoa, one of the Fortune 500 company. My father thought I was out of my mind. He's like, "What are you doing? You got this great job. They're paying you if you want to get an MBA. They're you're traveling and they're paying for everything. And why would you leave them to start a company?" He just back then, entrepreneurship wasn't as popular as it is today. But anyway, so I think what we did learn from my parents was hard work. They were very hardworking people, and I think in a ways they were mentors in that, hey, we see what if you work hard and work for somebody else, where that gets you. And I guess early on we figured, I figured out that, hey, I want to work hard, but I don't want to do it for a corporation.
Awesome. Well, thank you for sharing that. All right, Tom, if folks want to get in touch with you or learn more about Florida Funders, what's the best way for them to do that?
Yeah, floridafunders.com is our website. I'm Tom at floridafunders.com. Love to hear from your listeners. If anybody's interested in becoming an angel investor, and we have deals up on our site all the time that they can look at, and we constantly have educational things, webinars and seminars, and we're really focused on converting Florida, as we like to say, from sunshine state to startup state. We want this state to become as known for technology and innovation as we are today for the mouse and for strawberries and for tourism. So we'd love to have them along and join us on our journey. And Mike, thanks so much for having me on the show. I really appreciate it.
Thanks for doing it. This has been great. Thank you so much.
All right. Take care.
If you're thinking of launching a SaaS product, Startup Competitors can provide data on your closest competitors, survey potential users, or provide other product validation services. Learn more at startupcompetitors.com.